I think probably I'm more confident probably in the metals than I am in stocks in terms of the exact bottom. We haven't seen enough of a turn yet in equities to be sure, but boy, the reversal in the metals and the miners today is pretty convincing. And I think and prior to that, I saw a lot of things falling into place that told me I think we bottomed 9 trading days ago, and the silver got down under 55, just under 55, scared the heck out of everybody. And then there were, as always happens in these sell-offs, you get the technicians who jump on the momentum bandwagon, and they always have a lower low that it has to get to before it can turn. And you have all the retail investors and maybe others that listen to that, and then all of a sudden say, yeah, we can't have a bottom until we get to this. And it almost always, they have you waiting for a bottom that doesn't come, and then it turns before that, and you end up chasing. So I think we may see that again here. Silver is back up. I'm not sure where it is right now, but it was back over 59 this afternoon after War started speaking, and gold's up $60. So we had negative mornings in the metals and big reversals in the afternoon, particularly with the Fed meeting. I think there's a very good chance that we are in the beginning of that reversal. And my call has been and remains that we are going to much higher highs in both gold and silver. My target now, which was raised, I think, back at the end of May, my target now for gold is 7,000. My target for silver is 200. And I think we see those this year. So, nothing has to happen by any specific date, but there's a pretty good chance that it's going to be another steep run like we saw last December and January, meaning you could get, go from, the high 50s in silver and, 4,000 in gold and be at those levels in a matter of a few months, 3, 4, 5 months. Yeah, I don't really draw that comparison, so it's hard for me to say whether it's one or the other. I don't think it's either one necessarily, but I do think we are in a very different time than we were then, economically, and keep in mind, 2011 we came off the 2008-9 period, had a big run up in silver and gold, but we've both technically and fundamentally, I think we're in so much different place now. The prices are obviously much higher now. The mining companies are making money in a big way now that they hadn't in years, maybe ever. You're seeing cash flows there that you never saw before. And there's demand from sovereign, particularly in gold. There's industrial demand for silver, and all kinds of AI and EV, etc. So I just don't think we're at all in the same fundamental or technical place as we were back then. Like I said, when you get a run up like we had, and people forget, silver was, I guess probably back in the fall, down around 30, and ran from 30 to 122 in 6 months or whatever. And then, and a lot of people weren't paying attention to it when it was in the 30s and 40s, when it broke out above its all-time high of 48 or 9, and ran quickly from there to 122 in, less than 3 months. It attracted a lot of retail buying that was kind of saw the shiny object of momentum and jumped on, but they jumped on very...
By his own account, this forecaster's edge isn't chart patterns, it's sentiment. When fear dominates a market, he argues, a wall of worry keeps rebuilding every time prices near new highs, which paradoxically feeds the next rally instead of capping it. His case study is silver's historic run from roughly $30 to $122 over about 6 months, a blistering climb, followed by a sharp 50% pullback, then a scary retest of the lows. In his read, that's a shakeout, not a top.
So what you had was then the quick reversal, because it had gone parabolic, corrected 50%, and I thought that was the correction. It went down to 62, I think, in March. It basically went back to that same 62 level in May, and I thought that was a double bottom, and you'd go. Once it broke that scared all kinds of people that were big silver bulls as well as, weaker hands. And that's where the technicians started jumping in and saying, oh, we broke it down. We're going to 50. We're going to 40. I don't buy any of that. I think it's the classic case of what happens at a bottom. And I just think fundamentally and technically, this thing has a long ways to go. And again, the difference between this and equities, I think, are putting in sometime this year, are putting in a 44-year secular top, at much higher levels than here, but 44-year top is a big top. And whereas silver and gold, I think, they could top out this year for this cycle, but next cycle they'll go much higher. I have a 20,000 target for gold by the, say, 2032 or 3, and 1,000 target for silver. So the tops this year are cyclical tops. The top this year in equities is a secular top. Very different. I mean, there's always a risk that I'm wrong. I'm a human being making a call. So even though I've had a pretty good track record here for the last 5 or 6, 7 years, and before, but that in particular, it doesn't mean I'm always going to be right. So people have to understand it is my forecast. It's not a given. But I'm a contrarian. A lot of my work is based on sentiment, and sentiment, it just keeps, every time we get up there, there's something that causes the investor to get nervous, and that wall of worry just gets rebuilt so quickly. And so right now, it still looks, both technically and from a sentiment perspective and fundamentally, like there's more to go. And particularly what I like a lot when I'm talking about equities is how we have these groups that lagged for so long, financials and materials, small caps, have caught up this year or acting better this year. And their charts are wonderful. I mean, they have a lot of upside ahead. So even if you're nervous about AI and semis because of how far they've come and how sharp the correction is, the overall market still looks like there's plenty there to be positive about. And then, like I said, I don't think you're going to top out on either AI or semis before the top of the market. They've been the leadership the whole cycle. I think they will continue to be the leadership up into the top, meaning they'll go to higher highs. I think, however, the financials, materials, small caps, maybe even biotech, those kind of things, I think will outperform in this last run. Maybe.
The numbers he's throwing out are striking. $7,000 gold and $200 silver within this cycle, potentially reachable within months if last winter's rally pattern repeats. Looking further ahead, he floats $20,000 gold and $1,000 silver by 2032 or 2033. He's upfront that these are his own projections, not any kind of consensus view, and he frames them explicitly as forecasts rather than guarantees, even acknowledging that a solid track record doesn't mean this particular call is bound to play out.
Although now that semis have corrected as much as they have, it may not be an outperformance from there. It'd be an outperformance from where they were at the highs. But So all of that tells me, because of the sentiment, that there's still that next leg up, or that last run to the top that's steep. If you do the numbers, I haven't done them recently, but before we corrected, it looked like we had another 30 to 35, 40% left to go to the top. Now that we've corrected in some of those groups, it's more probably over 40% in the tech area. So there's plenty of upside still ahead, I think, and because of sentiment being so muted, basically so many people being skeptical, particularly institutions, that is fuel for the run. Because when institutions or any investor, when they're bearish, they've already acted on that bearishness generally, and that means there's fuel, when they decide they have to get back in because they're wrong. That's fuel for the next advance. In terms of what I'll look for at the top, because sentiment is so important, and because I'm a contrarian, because typically at bottoms, most people are bearish, or the most bearishness is at bottoms. At tops is when you see the most bullishness. So I'll be looking for that sign that everybody is all in. There'll be a narrative that's very bullish, telling you there's years to run. They'll have a fundamental narrative that will go along with that. People tell you the technicals look great. It's when you hear that across the board that you should start getting nervous. Doesn't mean that's the exact top, but it means it's probably time to start scaling out, or at least being aware that this thing could end at any time. We're not there at all right now. That certainly has been what was holding this market, particularly metals today, back. The worry that today we were going to see a hike, and we didn't, and that seemed to be the relief that kind of allowed all markets to rally. I got to see part of the press conference. I will tell you, before I answer your question, let me just say, I felt like I was watching my words being spoken by Kevin Warsh today. It's music to my ears that this guy is talking about letting the markets determine rates. That, he was pointing out that, they did a lot less talking since he became chairman. That we aren't seeing so many Fed members out there. They're not trying to predict what they're going to do, indicate what they're going to do at the next meeting. They really wanted to come in here, and he keeps saying, we're dependent on trends, not any particular data point. So, CPI and PPI last month, isn't the reason to be holding rates steady and not increasing. He said, that's what we want to get away from, is this data dependency. As we look, where we're looking backwards at data and data points, we really want to be focused on trends. I've said that so many times on X and in interviews, that's how I invest and how I forecast it. Basically trends. I don't worry about 1 or 2 months of counter move or what have you. He's talking like a portfolio manager would speak about how they see the economy, how they see forecasting, how they see rates, or more monetary policy, as opposed to an economist from academia. And it's a refreshing change. Kevin's got a background where he did have some exposure to the markets, and has certainly a wealth of experience. And when he was nominated, I say he's the perfect choice. He's like the guy that I would describe as the perfect Fed chairman, and he's not disappointing me so far. It's interesting, the last guy I can think of who was really a market-oriented guy was Bullock. But the difference is, it is just something that came to me today. The difference was Bullock would come on, and I'm not talking about necessarily after meetings, but just when he'd come on TV or talk, he liked to be out there talking, even though he wasn't chairman. He was just one of the members of FOMC. He's a good guy, but he talked like a trader would talk. He was looking at markets from a trader's eyes, sort of, as a monetary person, but with a trader's kind of bias. Whereas I see Kevin as looking at it from as a strategist or a portfolio manager would see it, how they understand how markets interact with things. They are very different, much longer term, much more, like I said, focused on trends and kind of a longer term, steady as she goes policy, with the eye on getting inflation down to their target of 2%, but not paying attention to what are traders pricing in for rates for the next 3 months. He doesn't. That's just not. And it's refreshing, because that's where we had gone. I don't know when it started, over a decade ago. It may have been 2 decades ago, but it's been all about kind of how traders see rates and and the Fed not wanting to surprise traders and all that. Kevin Warsh is a breath of fresh air on that basis.
While he thinks metals might be nearing a cyclical peak, he sees something bigger brewing in U.S. equities, a secular top, potentially the first one in 44 years. He expects AI and semiconductor stocks to keep leading right up into that top, even after their recent sharp pullbacks, while lagging sectors like financials, materials, small caps, and possibly biotech catch up in the meantime. His reasoning again comes back to sentiment. He argues that persistent institutional skepticism still signals fuel left in the tank, rather than exhaustion setting in.
Yeah, I think that was somewhat of a misread. Certainly Trump feeds into it because he just came out this week prior to the meeting talking about wanting lower rates. So you say, oh, here we go. Is it going to be pressure on Warsh now like it was on Powell? But I think there was a real misread by markets and certainly by the media. Trump was probably rightfully upset that he smelled a lot of politics in how Powell responded to things. Powell was really feeding into the media and and kind of Trump derangement syndrome. I don't know. I'm not saying he had Trump derangement syndrome. Maybe when he began, he certainly did by the end, probably because of the investigation, etc. But I do feel like Trump was more upset that he felt Powell was kind of like Yellen before him, a Democrat in a lot of ways, or certainly favoring the kind of mainstream media view of things when it came to Trump. Whereas Warsh is a solid citizen as a monetary guy. The other thing about Powell was an attorney. He wasn't a finance guy. He wasn't an economist. Warsh obviously has cut his teeth in the Fed, and everything about him is right for what the job is. So I'm sure, Trump is a real estate guy. He believes what he says. He believes rates should be lower. And you heard him this week talk about how the U.S. should have the lowest rates in the world, and yet we don't. And what's wrong with us? And I wouldn't want Donald Trump running Fed policy. Let's put it that way. On the other hand, I think in the long run, Warsh will be doing that, but not because of Trump. In the long run, I think you're going to see more, or at least the goal is more of an eye on long-term price stability. As Warsh said today, there's, my predecessors, or he said many of my predecessors, or some of them, certainly important ones, believe that there's a trade-off between jobs and inflation, the Phillips curve, that if the economy is strong, then you got to lean against it because it's going to cause inflation. And he's saying, no, I'm much more, and I don't think he said it today, but he's much more of a supply side guy who believes you can have easy policy as long as productivity is strong and you're creating enough capacity in the system to keep prices stable. And so it's a very different take again. I embrace that. I think that's the right way to think. And yet for years and years and years, it's all been this Phillips curve thing of, we can't have too good an economy or it's going to be inflationary and you're going to have to raise rates. And I think we're seeing a new sheriff in town, and I don't think he's going to have friction on the FOMC. I think he's going to bring them along. I think some of them are probably already there, but certainly many are going to have to be brought along. But he's not a guy that's coming in and dictating. He's going to make his arguments. He's going to use committees like he's formed to let the research prove the argument. And I think in the end, it's going to be a much more effective Fed.